Most people think the tax system is confusing on purpose. It's not. It's layered, it's incentive driven, and once you understand the structure, you stop reacting in April and start planning in January. In this video, I'm going to walk you through exactly how the U.S. tax system works. First, we're going to discuss how the U.S. uses a progressive tax system. This simply means as your income increases, higher portions of your income are taxed at higher tax rates. But here's the part most people get wrong. You are not taxed one flat percentage on all your income. You move up a ladder. Think of it like buckets. Each bucket of income is taxed at a different rate. Only the income inside the bucket gets taxed at that rate. So if you move into a higher bracket, that does not mean all of your income is taxed higher. It only applies to the dollars above that threshold. That misunderstanding alone causes a lot of fear. Next, let's talk about marginal versus effective tax rate. There are two numbers you need to understand. Marginal tax rate, the rate applied to your next dollar earned, and effective tax rate, the average rate you actually pay. Let's take a quick look at an example. Let's say you earn $100,000. You might land in a 22% marginal bracket, but your effective tax rate, what you actually pay on average, might only be 16% or 17%. Why? Because the first portion of your income was taxed at 10%, then 12%, then 22%. Understanding this difference changes how you think about earning more money. Moving up a bracket does not mean you lose money. It means you're earning more and only the top portion is taxed higher. Now let's discuss federal, state, and payroll taxes. When people look at their paycheck and think, why is so much gone? It's because taxes are layered. You don't just pay one tax. You pay federal income tax, state income tax, and payroll taxes. Let's break down how payroll taxes actually work. Every W-2 employee pays 6.2% for Social Security and 1.45% for Medicare. That's 7.65% right there. If you're self-employed, you pay both sides, which equals 15.3%. That's why side hustlers get surprised. This is called FICA tax. It's separate from income tax. So when someone says, I'm in the 22% bracket, that's not their total tax burden. Structure matters. Now let's go over gross income real quick. We take a quick look at W-2 wages, 1099 income, business income, dividends, and capital gains. Next, we'll have adjusted gross income. Basically, you subtract certain adjustments like your retirement contributions, your HSA contributions, student loan interest, and self-employed health insurance. AGI is one of the most important numbers in your financial life. Many tax credits phase out based on AGI. Third, we've got taxable income. From AGI, you subtract either the standard deduction or an itemized deductions. What's left is taxable income. That's what flows through the bracket system. Everything fits inside this framework. Now let's take a quick look at the standard deduction versus itemizing. Most Americans take the standard deduction. Why? Because it's large enough that itemizing doesn't make sense for them. You itemize only if things like mortgage interest, state and local taxes, charitable contributions, and large medical expenses add up more than the standard deduction. If they don't, you take the standard amount and move on. It's a simple decision rule. Now let's discuss tax deductions versus tax credits. This is another big one. A deduction reduces taxable income. A credit reduces tax owed directly. Let's take a quick example here. If you earn $80,000 and take a $5,000 deduction, your taxable income becomes $75,000. But if you owe $5,000 in taxes and get a $2,000 tax credit, you now owe $3,000. Credits are more powerful than deductions. That's why education credits and child tax credits matter so much. Now let's look at withholding and refunds. A tax refund is not a bonus. It means you overpaid during the year. When you start a job, you'll fill out a W-4 form. That tells your employer how much to withhold from each paycheck at the end of each year. If you overpaid, you get a refund. If you underpaid, you owe money. The goal is not a massive refund. The goal is precision. Because a refund means you gave the government an interest-free loan all year. Now let's take a quick look at earned income versus capital gains. This is where this tax code reveals its incentives. Earned income, such as wages, salary, business income, is taxed at ordinary income rates. Capital gains, such as profits from investments held longer than 1 year, are often taxed at 0%, 15%, or 20%. That's usually lower than high income tax brackets. Why? Because the tax system encourages capital formation and long-term investment. This is one reason asset ownership is powerful. It changes how your income is taxed. Now let's discuss this system is incentive-based. The tax code isn't random. It incentivizes behavior. It encourages retirement savings, such as IRAs and 401ks, health savings accounts, home ownership, business creation, and investment. If you understand incentives, you understand taxes. The system rewards certain behaviors. When you align with those incentives, you lower friction. Now, we also want to go over a clean structure. You've got your income, you look at adjustments, deductions, taxable income, you apply brackets, subtract credits, compare withholding, and then you have a refund or balance due. That's the entire machine. Every complex tax scenario still fits inside this framework. Once you understand the framework, it's easy from there. Let's take a quick look at common misunderstandings. Let's clear up a few myths. My income will be lower if I move into a higher bracket. That's false. Refunds mean I did well. That's not necessarily true. Only wealthy people use tax strategy. Also false. Planning is not cheating the system. Planning is understanding the system. There is a difference. Next, let's discuss what this means for wealth building. If you want long-term wealth, you must first control taxable income. Second, use retirement accounts intentionally. Third, understand self-employment tax if you have a side hustle. Fourth, shift income towards assets when appropriate. Fifth, plan during the year, not during filing season. Taxes are one of your largest lifetime expenses. Ignoring them is expensive. Understanding them is leverage. The U.S. tax system is progressive, incentive-driven, structured, and predictable if understood. When you stop fearing it and start studying it, you'll gain clarity. Appreciate everyone watching the video this week. If it's helped you any, hit the like and subscribe, and we'll make another video next week.